Welcome back to another episode of Rogue Wealth. Today, we're going to be talking about what it's like to be up 3,000%. And what do you do next? How do you ride your winners like you actually mean it? What's growth investing? How do you risk manage that space? And then how do you deal with the taxes? These are the things you don't hear about and don't read about. Nobody actually teaches you. We're going to break that all down here today. So everybody wants the big winners. You want the 3,000% gains, but nobody addresses what you do when you get them. It leaves you up to debating on if how many people actually deal with those types of returns. But when they do, what happens next? Growth investing doesn't have to be reckless. It's actually a strategy that you can use. And going back to a recent article I did in Family Business Money, ride your winners, cut your losses, but let those winners run with a strategy and a process, not with just something you read off the internet and hoping that it's the next lotto ticket run. So how do we define growth investing? So the core four components of today's conversation are defining what growth investing is, executing on it, managing it, and then keeping as much of it as you can from taxes or a future crisis or drawdowns or the trade being held on for too long. So when does growth investing fit in a diversified portfolio and why do you need it? Personally, I believe that growth investing fits in every portfolio. Now, that doesn't mean that the entire balance sheet or an entire account or everything you own should be piled into growth type of investing. But an exposure in growth investing accentuates a return profile. It diversifies away from other risks that happen, mainly inflation and debasement. It adds a little more conversation at a cocktail party as well, but you don't have to be reckless about it. And frankly, value has its space. The market dynamics have changed significantly. Dividend, interest rates, yields, and returns have been struggling to kind of catch traction as we frankly shift into a different world of higher interest rates, higher inflation, structural changes, and I think we're permanently looking to undo the whole globalized world that we're living in. And with that comes these big structural changes. The other thing that happens with growth investing is you have themes and setups that take time to play out. When you're buying these growth name companies in these growth businesses, you're not buying them for their earnings yield or earnings ability or profits today. What those companies have figured out is that they give up their profitability today for future growth. And they're reinvesting and constantly dumping money into the business. And that's what value investing and the more traditional old school value investors miss. They look at a metric and they say, hey, well, the PE is way too high here, so it doesn't make sense to buy. But what they miss is a lot of these businesses and these entrepreneurs and entrepreneurially minded leaders are doing is they're recognizing that they can take their profits and free cash flow and redeploy them back into the business in capital expenditure, in gathering market share, and eating up their competition to grow faster for longer periods of time. And so that buy and hold, boring dividend portfolio of bricks and sticks or brick and mortar type of businesses have a space in the portfolio, but they don't do and they can't carry the return profile that growth typically does. And so I think having that in a portfolio sitting alongside a balance sheet with all of your other stuff really captures the upside and structural shifts and allows for building generational wealth in a portfolio and looking at getting over the hurdle rate of inflation and debasement, which you've heard me talk about as a big issue in the past. The tension that does come up, though, and why you have to have some sort of system or process with growth investing is look, if you look at cycle-adjusted PE ratios, if you look at different valuation metrics, whether it's CAPE, whether it's the Buffett indicator, whether it is something as simple and basic as a PE ratio, markets are expensive. We've seen historic highs in various asset classes, not only in the US, but around the world. Housing prices, stock prices, the price of gold. You can go overseas and do the same thing. The question is are we over leveraged? Is there a bubble? Are we expensive? Sure. But that's not enough reason to say you're going to sit out, because those conditions can continue on for a long time. And so growth is a strategy that you can use, a tactic and a sleeve in an overall portfolio, but you can never get it to be such a big thing that when that tide turns, and those tides do turn, history has shown that to us before. When that happens, you don't let it take you out. You should be able to survive through it. And there's many examples in the last 1, 2, 3 decades of just screaming performance returns in names like Intuitive Surgical that have revolutionized surgery, Monster Beverage of all things, the former Priceline, now Booking, eating the lunch of the traditional retail travel booking experience, Amazon and what they've done and what they continue to do in their business, reinvesting those profits and disrupting other parts of their business, whether it's AWS cloud or it's their logistics business or their last mile delivery. They're eating other competitors' lunch that those own competitors fail to recognize and do themselves. Netflix is another example. We've seen that with Tesla and more recently Micron, which I know the big debate and the big excitement today is about hot IPOs, whether it was Cerebras or SpaceX, whether it was the incoming Anthropic or OpenAI deal. But look at Micron, look at NVIDIA. These are names that have been around for 20 or 30 years that have had monstrous outsized returns, but they didn't happen overnight. They didn't happen where you read about it on a forum or an article that a friend sent over to you and you had to get in on that day. You can get into these positions and build these stories and build the exposure, but you have to let them work alongside your portfolio. And they happen, and they're going to continue to happen. The common themes that we see is basically what companies are eating the lunch of their competitors or leading the disruption that no one else can keep up with. The market gets caught up on the quarterly performance and quarterly earnings and the quarterly profit, while these businesses are slowly being led like entrepreneurial enterprises, solving big problems, and they're doing things that other businesses are just worried about hitting their number. And these are generational examples, and there's many of them that we've seen where momentum and the growth and their reinvestment and their discipline compounds and builds significant wealth. And that brings me on to Rogue Wealth Rule 11. Momentum is your friend. When you have price action heading in the right direction, embrace it and run with it. Use it to inform you, but don't fight the tape. Fighting the tape doesn't make sense. Now, moving on to core component number 2, execution. How do you do it? Well, there's really 2 ways that I can see it done. One, do it yourself, self-directed. You identify, you research, and you buy. It's pretty much it. The upsides of that, there's a learning curve. You have full control. You can decide what you want, when you want it, how much you want it. The downside, the time, effort, energy, and any bias that comes up. And frankly, a little bit of that FOMO influence that comes from the socials and our friends and our peers that might bully us into something. Or that feeling of, hey, this is a lottery ticket. This is the next one. You get a lot of chasing and following things that might not work. The thing that I've found that works the best in self-directed, and what I do for myself, and what we do when we make decisions, is you read a lot, you go down crazy rabbit holes, and you debate. The rabbit holes and the debate part really help you uncover or identify the things that might be leading a company into a generational run, but it might also be the ones with like, this doesn't make any sense. It's not going to catch, or it just sounds foolish. We should get out of it. The second way to do it is hire an expert, get a manager, whether it's an ETF or a fund or an investment club or whatever it is. You can basically give your money to someone else in a legal fiduciary capacity, delegate to them, because the pros there is they have bandwidth, they have expertise, they have people that execute on this and eat, sleep, and live this type of investing style better than an individual can on their own. The downside, Fees are always something as an issue, but if the fees rationalize the value and the return and the style and the time saving that you get, it makes total sense. The other thing is maybe a philosophy mismatch, maybe the style of growth investing or the type of companies they're going after, or how much appetite they have in starting a position, owning it, holding it, and so on and so forth. That you can't really control that much. So those are some cons to consider. And the third way is just a mashup. It's a hybrid. You basically take a systematic, rules-based approach to momentum and layer in a check-in with a professional that you use, whether it's your advisor or the team, and you can have a blend of discipline plus oversight and still delegate your time to go do whatever it is that you do really well. As a business owner, most business owners are capital allocators of their own business. They know their own business really well, but they don't have that same level of insight and intuition into their own portfolios. And so growth investing requires conviction or process. You have to pick between the two and decide which one fits you while you're busy running your business and allocating capital there. And so what's the difference between conviction or process? Conviction's being able to hold through an investment or a thesis or a theme, regardless of what one day of news or a quarter of earnings does to the company. You have to be able to say that this is the theme that I see build out, like Priceline, for example. Priceline simply eating the lunch of the traditional travel agent business model is going to take time to see through, regardless of if there's a heavy Atlantic storm season and people just aren't traveling that much. Does that theme and thesis break out over long periods of time? That's conviction. You're in it. You're in it just like you're in your business. You don't just turn the lights off and sell the thing if you don't like it on a Tuesday. And on process, if you decide that process is your way to get to growth names, you need to figure out the parameters. Are you looking for margin growth? Are you looking for market share? Are you looking for CapEx and capital reinvestment? Whatever those things are, pick one or pick the blend and don't flip them around. What I've seen hurt portfolio performance and investment decision making is as often as you're buying and selling names in your portfolio, you're changing the ingredients on how you get there. So you never really let anything catch traction. And to think about compounding is compounding rewards consistent process and results in consistent outcomes over time. And the worst execution, the worst in the pick is what I alluded to, chasing FOMO. You hear about it, you read about it, you scroll past it, and you're like, that's what I want. Frankly, with the recent run of IPOs and some of our incoming recent upcoming pipeline of IPOs, there's going to be a lot of FOMO. It's going to be a lot of eyeballs, a lot of ears, hearing a lot of things, revolutionary, the hottest thing ever. That level of excitement usually results in panned out. It smells great, but it was a horrible meal type of experience. Remember, whether it's the day of IPO or the fifth day of trading, that 1 or 2 days doesn't make a difference if you're going for those 3, 4, or 5,000% returns that happen over longer periods of time. And so the best way to execute here is find a repeatable decision framework, whether you do it on your own, you do it with a professional, or you find some sort of intersection hybrid and stick to it. All right, so we've defined what growth investing is, and now I've given you ways on how to execute it. How do you manage it? Because you just crushed it. You've just gotten your position at 3,000% returns or 4,000 or 5,000 returns. What do we do now? So you can utilize de-risking strategies like taking some cream off the top. As that price performance and that position's running, you decide through your process, hey, you know what? This thing at $350 a share is a little over its skis. I have a lot of exposure. I can take some off that top. And you can decide to sell them in tranches of whether it's 100 shares or 1% at a time. You can use option strategies like protective puts or collar strategies to cap the upside but limit the downside if you really want to lock in those gains. You can decide around portfolio construction just systematically. How much growth do I want to have in my portfolio? Do I want this one name to take up 5, 10, 15% of my total portfolio? Maybe it's industry dependent. You might have 5 or 10 different names in the memory and chip space? Do you want that industry taking up some percentage of your portfolio? And that construction decision is what decides when you sell or how much of any positions you sell. And then what about rebalancing? You can decide to trim your winners. That's that first decision. But the second one is what do you do with the money? Do you recycle it back into the same industry? Do you go back into an income-based portfolio? Do you do the buy and hold, buy the index until you get another name or another idea or theme that shows up? Having that outlined before you do the trade makes execution of the trade a lot better. What about some scenario planning? It's not crazy that a momentum-based, growth-based portfolio with no brakes and no airbags draws down 90%. We've seen it happen before. We've seen it in the 80s. We've seen it in the dot-com bubble. We've seen it during the great financial crisis. And we've seen it again during the pandemic era, and then again during the wild inflation and then interest rate run of 2021 and 2022. High growth names get washed out when the broader market has some significant challenges. Run that scenario through your head and through a napkin or whatever your process is, and figure out what would you do if that situation presented to yourself. Would you freak out and sell everything? And then it's probably too big of a position to begin with. Or would you utilize that as a dollar cost average dip buy opportunity? If that's the case, that's where the conviction shows up. But run these scenarios and run it through your process every time and get really clear. It's very important for you to have clarity and explain your conviction. Because if you can't explain your position or your theme and it's just in your portfolio, that's FOMO. It's probably too big, and it's probably not something that you want to have in your portfolio when the market does turn, because we know it runs in cycles. And so remember that growth positions can become income machines if structured correctly with covered calls or with other option strategies. And risk management isn't a weakness in this entire process. Risk management and position management is actually critical in being able to get to those 3, 4, and 5,000% gains and knowing what you do with them on the way there. All right, next one, taxes. This is the keep phase of our components. How do you tax manage monster games? And what's funny to me is that I hear this too often. I don't want to sell this position. This thing's such a monstrous winner. We made so much money on it. I don't want to pay the taxes. Well, look, let's be honest. Paying taxes on a 15% or 20% after-tax annualized gain is much better than paying zero on a 0% return. You follow me? At some point, you got to pay the tax man, particularly if you're getting these big outsized hits. So what can we do to minimize it? Well, the first thing we can do is there are public and private exchange funds that let you roll or exchange highly appreciated big gain positions into a diversified basket and basically moving that tax bite forward. So you take a conviction, big position, one big position, and you can pair it up with another part of your portfolio, exchange it into a fund, and basically defer the tax bill and get diversification along the way, okay? The second thing is you can continue to keep that portfolio position on and use income. So you can write calls and do some collars and have one pay for the other. This is where you'd want to consider professional help because it does become a part-time job, but you can generate income off of your portfolio and possibly be in a more tax-efficient strategy than selling and managing the timing in the future at some point to when you want to sell that position down. Maybe your personal tax bracket changes, your household income changes, and you can fill up buckets of lower capital gain taxes in the future. The other thing is charitable gifting. You can donate appreciated shares directly to organizations that align with your values, that you want to give or make an impact with. You can give those shares and gift those shares forward. The other parts of your portfolio might be generating losses, and you can use those losses, capture those losses, put them on your, get them on your tax return, and then equally sell an equal amount of gains in these monster winners that you have, and try to get that position management, risk management aspect while minimizing the tax bite. But remember, as I said, and I opened up this component here, at some point you got to pay the tax bill if you want to position manage your exposure. And it's crazy to me that people won't sell only because of the tax bit, when frankly, you could have a drawdown. You could have a big fortune turn into small fortune. Don't make it because of the tax bit. Doesn't make any sense to me. So in closing, we've walked through defining growth investing as it makes up your portfolio structure, how to execute on getting into those names that could get you to life-changing returns, how to position and risk manage portfolio positions, and then lastly, the tax bit of it. What do you do when you crack your statement open and you look at your cost basis and you're like, holy shit, this thing's got 5,000% returns on it. I don't want to pay any taxes. So this is why I exist as a financial bodyguard. We look at architecting this entire setup, not just one sleeve of the portfolio, but the entire game plan. And there is a process of getting rich, and then there's a process of staying rich. In staying rich, you don't want to chase names. In getting rich, you don't want to chase them either. You need to have a process along the way, walk through the scenario, and know what you're getting yourself into before you ever hit the buy button. Because it's much easier to hit the buy button when you know how to get out, when to get out, and it's much easier to get to those big time returns without getting the emotional roller coaster of chasing names. And on that note, as a reminder, none of this is investment recommendations. Do your own research, call your people, call your experts. I don't know your personal situations, but I do strongly recommend to having a process that's formalized around your growth investing and having it make a significant part up of your portfolio. Get professional help, and thank you. I'll see you in another future episode of Rogue Wealth.